Ever wondered what subordinated debt is? Well, let's unravel this financial term together. Subordinated debt, also known as a subordinated loan, junior security, or subordinated bond, is a loan or security that stands a step behind in the queue when it comes to claims on a company's assets or earnings. Imagine a line of creditors, each waiting to be paid. In this line, subordinated debt is not the first, not the second, but likely even further back. Yes, it's the patient one, waiting its turn while other forms of debt get paid off first. So, why would anyone want subordinated debt? Well, often it comes with the potential for higher returns, as the risk involved is greater. But we'll dive deeper into that later. In essence, subordinated debt takes a backseat to other forms of debt in terms of payment priority. So, what makes subordinated debt unique? Well, several features set it apart. Firstly, in the unfortunate event of bankruptcy where the issuer's assets are liquidated, subordinated debt is low on the priority list. It gets paid back only after other bonds and obligations have been satisfied. This makes it riskier than other forms of debt. Secondly, the interest paid on subordinated debt is tax deductible. This can be a significant advantage for the issuer as it reduces the overall cost of borrowing. However, this tax benefit does not eliminate the risk associated with this type of debt. Remember, the riskier the debt, the higher the potential return. Subordinated debt often comes with higher interest rates to compensate for the increased risk. This can make it an attractive option for investors seeking higher returns, but they should be prepared for the possibility of losing their investment. The characteristics of subordinated debt make it a high-risk, high-reward investment. Now that you understand what subordinated debt is, you might be asking, what role does it play in financial markets? Well, let's dive right in. Subordinated debt is an excellent tool for companies to raise capital. It allows them to secure funds without diluting ownership, which is a common concern with equity financing. Furthermore, it provides a cushion for senior creditors. In the event of a company's liquidation, senior creditors get paid first, while subordinated debt holders wait in line. This protective layer makes senior debt more attractive to creditors, leading to a better credit rating for the company. However, the company's credit rating can also be negatively impacted if it takes on too much subordinated debt. It's a delicate balancing act that requires careful management. Despite its risks, subordinated debt plays a crucial role in financial markets. Like any other financial instrument, subordinated debt comes with its own set of advantages and risks. Let's first take a look at the upsides. One of the most appealing aspects of subordinated debt is its potential for higher returns. Since this type of debt carries a higher risk, lenders often demand a higher interest rate to compensate. This means that, as an investor, you stand to gain more from your investment. Subordinated debt also plays a significant role in diversifying an investment portfolio. Diversification, as you may know, is a strategy that aims to spread investments across various financial instruments to reduce risk. By including subordinated debt in your portfolio, you can spread out and possibly mitigate some of your investment risk. But as much as we love the idea of higher returns and diversification, it's equally important to consider the risks associated with subordinated debt. The first risk to consider is the risk of default. Because subordinated debt is lower in the repayment hierarchy, if the borrowing company were to go under, you, as a subordinated debt holder, would be one of the last in line to be repaid. In a worst-case scenario, you might not get repaid at all. Another risk is the lower priority in repayment. In the event of bankruptcy, senior lenders are paid off first, followed by unsecured creditors, and then subordinated debt holders. So if the company's assets are insufficient to cover all debts, subordinated debt holders may receive little to no repayment. In conclusion, subordinated debt can offer an attractive avenue for higher returns and portfolio diversification. However, the risks that come with it, such as the risk of default and lower priority in repayment, are significant and should not be overlooked. While subordinated debt may offer higher returns, it is essential to understand the associated risks before investing. So, there you have it, a comprehensive overview of subordinated debt. We've journeyed through its definition, a type of debt that ranks after other debts if a company falls into liquidation. We've explored its unique characteristics, its impactful role in financial markets, and the potential advantages it holds, like higher returns. But we also acknowledge the risks, such as the potential for loss if a company goes under. Understanding subordinated debt can help investors make informed decisions. Remember, always consider the risks before diving into any investment.